Tandem Investment Advisors presents Tandem Talk, the quarterly financial podcast bringing you a seat at the table with Tandem's investment team.
Hello, viewers and listeners. Welcome back to Tandem Talk. This is episode 24. My name is John Carew. I'm joined by Tandem's investment team of Billy Little,
Hello, everyone.
Ben Carew,
Hey, how's it going?
and Jordan Watson.
Hey.
All right, new setting here, guys. I kind of like this setup. A little more comfortable. But so the last time we got together for Tandem Talk was in February. And since then, we sort of lived through an AI bomb, putting software and services out of business. We then had a war. As wars go, it didn't last very long. And as sell-offs go, it lasted even less time. But I want to get to the meat of the matter. And Billy, I'm going to start with you just to get your overall take on things, because this market this year is kicking us in the teeth. And I think we ought to discuss what's going on with the portfolio, bigger picture, whatever. Everybody gets a turn. Let's start with you, Billy.
Yeah, I mean, this market, as we all know, it's being dominated by technology, AI specific. And if you're not on the AI train and you're not selling chips, you are being left behind. I'll give you this interesting stat that I actually saw in an article I read yesterday or 2 days ago by Bespoke, and they listed the top 30 names, that the top 30 outperformers the year before the height of the tech bubble, so 3/24/99 to 3/24/2000, and then they listed the top 30 underperformers during that time period. The top performers were averaged up 582%. The following year, they were down 53%. Some of those names included Apple up 311%, Xilinx up 360%. What's more interesting, I think, from when we talk about kind of our portfolio, are the names that were actually the underperformers that year before. Those names declined an average of 54%. The following year, they were up 35%. Those names included Waste Management, down 70%, Raytheon, down 67%, Allied Waste, down 60%, Winn-Dixie, down 53%, Yum Brands, down 55%. These are names that are similar to what we have in our portfolio. So I just thought it was an interesting stat to bring up. Is it does, not everything is going to be the same, but it's kind of rhyming a little bit.
That's well said and good nugget. So if I may, I'd like to go to Jordan, because Billy, you mentioned chip stocks. Mm-hmm. Jordan, you write a piece that we call Notes from the Trading Desk, and you wrote about our foray into chip stocks. You want to share with the viewer listener?
Yeah, Tandem bought a chip stock, but it's PepsiCo who owns Frito-Lay. It's not a semiconductor stock. But yeah, to Billy's point, and Billy, I saw that Bespoke piece also, and I thought that was really interesting. To what extent do you think that's a function of the chase, right? Like, we've seen this really big rally off of the March lows with semiconductor stocks up 60%. People have said it's the widest divergence between the stocks and its 50-day or 200-day moving average since the top of the tech bubble, right? There's been this explosive move higher. Not all stocks have participated in that. In fact, some have sort of taken it on the chin more, if you will. To what extent do you think sort of the quality stocks selling off that you saw back in the 90s and then a bit today is people just sort of dumping, selling whatever they can and just chasing?
Oh, absolutely. I think that has most to do with it, right? Money's got to come from somewhere. So it's coming from these companies who don't have AI in their name and they're not producing a chip. So yeah, money has to come from somewhere to fund the purchase of what's working. This is clearly, and it has been for a while, a very momentum-based market, and momentum can work both ways. Momentum going up, these whether it be passive indexing, is constantly buying the things that are going up. The things that are going down, They're constantly selling the things that are going down. I would think that flips one day. I don't know what day that will be. Hopefully sooner than
It's
later.
going to be Tuesday. It's going to be Tuesday.
But yeah,
I don't know which Tuesday, but it's going to be Tuesday. Billy, a lot of what you're talking about, though, is the indiscriminate treatment of stocks in today's marketplace, because what's being bought and sold in volume is baskets of stocks, ETFs, right?
Absolutely.
It's not like they're hitting the sell button on XYZ and buying ABC. They're buying baskets of what's working and selling what isn't working. The amount of options that are being used today is unprecedented from an historical standpoint. The reason that's important is because options don't take nearly as much capital to buy and control as a stock does. Options are often traded on margin or with borrowed money to leverage, to amplify the movement or the returns. And that is the environment we find ourselves in. Ben, you haven't joined this conversation yet. I'm sure you have something to say, so let's hear from you.
No, I think that you guys hit the nail on the head on a lot of those things. I think that dollars are finite when it comes to investing, as Billy touched on, unless the money printer is on and they're issuing checks like they were in 2020 and 2021. Otherwise, to buy something, you have to sell something, right? And so I think that's the dynamic that we're seeing today. I think that's the dynamic that we saw in the late 90s. The low volatility index, by the time the S&P was setting its final high, was in a bear market, right? And Billy sort of danced around that a little bit by talking about the specific names. But you saw the S&P 500 low volatility index over 98 and 99 draw down 20%, while the S&P was cruising to all-time highs, right? And so it's a very similar dynamic. You sell the boring, consistent thing in favor of the very shiny new object. And Billy, you had said that if you're not selling chips, this isn't a good market for you. It has, and I know that you're just sort of speaking generically, but I think it's worth pointing out it is broader than that, right? It's not just the chip makers that are doing well, but it is still incredibly narrowly focused in that you have to be in the AI infrastructure trade, or perhaps more specifically the data center trade, right? So you're seeing some industrials do remarkably well in this market. You're seeing some utilities do well in this market, right? But the theme from pocket to pocket is exposure to this AI data center build out, right?
Yeah, no, that's fair.
So we're talking an awful lot about the broader landscape, and that's good. I think that's helpful. I think that sets the framework. But I would like to speak more directly to the businesses that we own. Ben, you've done a lot of work on this. I've done a little bit myself. What I uncovered that I'll share to kick this topic off, and then y'all go with it, is over time, there is a meaningful correlation between earnings and dividend growth and share price appreciation. Not all the time, but over time, right? There was a line from Moneyball. I recently read the book, and in the book, it is said that sometimes a good process can produce a bad outcome, but that doesn't make it a bad process. Share price appreciation and earnings and dividend growth have very little correlation in the short run. But over time, historically, our average holdings have grown earnings and dividends, and share price appreciation has roughly paralleled that rate of growth. Ben, take it from there, because you have more recent statistics, and then you can even speak to how discounted we are today relative to where the market is.
Sure. So I have the numbers off the top of my head, basically for large cap core. So what I'm about to talk about is large cap core specific, not necessarily mid cap core or equity specific. So John, you're exactly right. I mean, over the past decade, the average holding in the portfolio today has grown earnings about 12%, and it's grown its dividend a little shy of 11%, right? So 12% earnings growth, 11% dividend growth. And over the past decade, the average holding has appreciated sort of right between those two, sort of split the goalposts, right? And that's what you have seen historically. That's quite normal, a relationship over a decade to see uh, earnings and price and dividend, or to see price move with earnings and dividend. That's totally normal. Correlation is essentially non-existent over a 1 year period. And so if you look at our holding over the last year, the average holding in large cap core over the last year, it's actually done better than average in terms of earnings growth. The average holding in large cap core through the end of the first quarter had grown earnings year over year about 13 and a quarter, right? That's terrific. That's well above the nearly 12% growth rate that I mentioned for the past decade, right? So our companies, if anything, are actually doing more than we could ask for them from an earnings standpoint. Dividend over the last year, a little north of 10%, still right in line with historical averages. What is different though over the last year is that the average stock in the portfolio is down year over year, down almost 7%, right? That's remarkably different than that long-term relationship, right? And so in the short run, the relationship between earnings and price is almost irrelevant, right? In the short run, what matters is sentiment. But in the long run, fundamentals are what matter. And I don't know when the short run becomes the long run, but I know that it eventually does. And so long as we
Tuesday.
continue to have a
Tuesday.
portfolio that can consistently grow, I'm not worried about the share price appreciation in time. It will come. John, you had mentioned valuation to a certain extent. And so we did a similar analysis looking at the each individual holding in the portfolio and comparing its PE today to its historic PE, right? And sort of where it's traded over the last 10 years. And so if you believe in mean reversion, then you buy something when it has deviated in a statistically significant manner below its long-term average, and you trim something or sell something when it's deviated significantly above that long-term average, right? So the average holding in the portfolio today is about 13-14% below its historic PE, right? That means that the average holding in the portfolio today is attractively valued. You do that same analysis onto the S&P 500 today, and the S&P 500 is about 28-29% overvalued, right? So one of those things is historically undervalued. One of those things is historically overvalued. And it doesn't have to be new doom and gloom for the Tandem portfolio to catch up, right? You just have to see those two numbers converge on one another. The Tandem portfolio to revert back to its fair value, right? The S&P portfolio to also revert back to its fair value, and all of a sudden things are normal again, right? But this is essentially the cheapest that our portfolio has been relative to itself in over a decade.
Jordan, haven't heard from you in a minute, but you did share a fun little fact about a stock from the 1960s with a ticker symbol NDV dot. It was NVD.A, or
Yeah,
basically the
yeah,
same ticker as NVIDIA.
that's right.
National
National
whatever.
Video. Uh, yeah, so in the 1960s, so I got this from Walter Deemer. He put this out, but in the 1960s, there was a company called National Video. They were the first to make TV picture tubes that were, color tubes for TVs, and it became the industry standard. Everyone was scrambling to get their hands on National Video's tubes. The stock went from $15 a share to $120 a share in a year. And the last 70 points of that came in a few months, right? But eventually, the big sort of industry giants at the time, the Motorola's of the world, started making their own and realized we don't need sort of National Video's tax, if you will, on our business. We'll just bring it in-house. And the stock really got hit on it, right? In the next few years, its product was basically obsolete and the thing went bankrupt. Now, two different scenarios, right? We're not saying that the NVDA of the 60s is going to repeat itself, but I would say there are some echoes of similarity in the market today where the hyperscalers are bringing chip production in-house, whether it be Amazon or Google, their TPUs, and they're trying to become less reliant on NVIDIA's of the world, right? It's the hyperscaler model that Ben's talked a lot about, right? Their business model over the last decade is essentially what's our biggest expense and how can we bring it in-house and do it more efficient? And you're seeing that with chips. You've got there's a ton of demand. You hear about this infinite wall of demand on the compute side, But there's also a lot of supply coming on. I mean, there was Cerebras, that semiconductor IPO that took place last week. And when their shares started trading, to the earlier point about cash has to come somewhere, you saw broader semis sort of sell off to chase that, right? So, I think Walter Deemer brings up an interesting analog, but you're beginning to see the hyperscalers bring chip production in-house to become less reliant on third parties. And I think that trend only continues.
So the thing that strikes me, Jordan, is, or whomever wants to comment on this, it seems that the market believes that there are an infinite number of winners, which is incredibly reminiscent of the 1990s, right? There are winners and losers, and the market is picking them right now. But in other capital expenditure booms, like the one that we're experiencing today, those were primarily led by industrial companies, not software and service companies that decided to spend literally trillions of dollars to build out physical plant and equipment. But they ended up in past boom cycles like this, putting each other out of business. When railroads first came into being, competing railroads would build the same route and compete for business. The capital expenditures were too great to have to compete. So they finally figured out, okay, you can have that route. I'm going to take this route. When electrification came, competing utility companies were putting up power lines to sell power to the citizenry. And finally, they figured out it's okay for your utility to be a monopoly because the capital expenditure is so great that nobody can win that game. Yet today, we literally have, I don't know how many there are, but the 5 ones that we call hyperscalers, the public ones are 6, I guess: Meta, Alphabet, Microsoft, Amazon, and then the private ones are OpenAI and the other one.
Oracle, Anthropic, SpaceX could
Anthropic is
arguably even be in that territory now that
yeah.
SpaceX is selling
And,
compute to Anthropic.
and they're all acting, we as a market are acting as if they all just win, and they don't. This usually ends well for us, the beneficiaries of new technology, but the companies we bet on early on rarely are the companies that ultimately survive. The best companies are the ones who figure out how to operate in this new paradigm using artificial intelligence to complement their existing business, right? Is that fair to say?
Yeah. Yeah.
All right. Well,
John,
yeah, go ahead.
do you think that I'd like to, I think it'd be great if we could spend a little bit of time talking about sort of the macro backdrop just a little bit in terms of valuations and the market concentration. I know that's
Go
stuff that we've
for it.
spent a lot of time on recently, but I think it ties into something that you've been talking about, the tech bubble, recently, and it's a good point, and I think it's worth making. So I saw a chart from Macro Bond recently, which shows it combines PEs, price to books, EV to EBITDAs, market cap to GDP, all of these different valuations, and it combines it into one composite number, and it goes back to 1900. It shows that today, U.S. stocks sit in like the 97th percentile. The highest that they've ever sat on this combined metric where everything's being rolled into one number is 98. Right. And so we're as expensive as we were in the late 60s. We're as expensive as we were in the 2000s. Right. So valuations are really, really high. We talked about concentrations. The S&P, these AI names, made up more than 40% of the S&P of late. The tech boom and telecom in the late 90s and early 2000s got up to about 41%. In Japan in the late 80s, concentration within that index got up to the mid 40s. And the Nifty 50 in the late 60s, early 70s got into the low 40s, right? So you have this extremely concentrated market, extremely rich market, and that has historically not been a great thing, right? Oh no, here comes Tandem preaching doom and gloom. Not at all, right? I don't think that we're sitting here trying to predict some 50% pullback when we draw the analogy to the tech bubble, right? yes, from peak to trough in the tech bubble, markets retraced about 50% of its value, right? But John, I wasn't here. I wasn't managing money then. You want to talk about the difference between perhaps the tech bubble and that actual drawdown?
Yeah, yeah, that's a good point, Ben, and thank you for bringing that up. So I think people like us who see the similarities between today's market and the late 90s through March of 2000 will say that they assign to us the notion that this we're looking at a massive sell-off, that this bubble is going to burst and it's going to be really ugly. The reality of the tech bubble bursting was a 25% sell-off. To frame that, we had two 20% sell-offs in 2018. We had a 25% sell-off in the middle of 2022. That is not earth-shattering because I bet most of our viewer listeners don't even remember that. And not because they're too young, but because it was just so sloughed off, right? But the market fell from March of 2000 into spring of '01 about 25% and began to stabilize. And then you know what happened next? The Twin Towers fell. Air travel shut down. The hotel industry shut down. The country shut down. We went into a deep recession and the market
showed that,
fell
right?
another 25%. History treats that like it's all tech bubble related, and it's not. That was two separate sell-offs for two separate reasons. Yes, we believe this market is historically overvalued. We believe that this market is narrower and narrower and narrower. We believe, because we have our own evidence to believe, we actually have a young strategy here that we call quality momentum based off of our process, but instead of relying on mean reversion, we use momentum. And its performance looks vastly different from our traditional portfolios, right? This is a momentum-driven market. And historically, that has proven to have a very sharp rise, and it's not sustainable. And what has become unsustainably cheap and what has become unsustainably expensive converge somewhere in the middle, right?
Well said.
All right. Before we sign off here, does anybody have anything else they want to touch on that we didn't get to today?
I think the only thing that I could really maybe add or touch on, John, based off of what you were just talking about, sort of again, avoiding the doom and gloom and catastrophic pullback that I think sometimes people maybe associate with large valuations. Since March 30th, momentum is up 30+%. Right? Over a 6-week period, it was up almost 35%. That's highly unusual, right? Momentum could pull back 20% and it would still be up nicely, right? So, and then the space that we invest in is down 10+%, right? It's not crazy to think that our space could be up 10% or 15% to get back to somewhere normal, right? I mean, shoot, the PE that we talked about earlier is about down 13, 14%. Just a reversion back to fair value is 14% higher, right? Momentum is so far off size and the S&P is so expensive right now that if it just comes down a little bit, these two things revert, right? I think sometimes we think everything in the market moves in lockstep. That's not the case. We seem to have just sold off earlier this time, right? But I think that if you just sort of see some sort of return to normal where the two things just divert or just converge, sorry, not diverge, you see really quick makeups in terms of performance in either direction. So that's the only other thing that I'd out there. I'm not predicting that. I'm not saying that's going to happen. I just don't think it is as far-fetched. I mean, I talked to an advisor the other day who said, I have an account that's down 7-8%. Is it going to be years before they're back to even? It's like, what are you talking about? Right? No, not at all. That's not a lot of ground that one has to make up.
And you saw it in Q1 of last year, right? Where it was momentum based up until that point, and then you get a broader sell-off in technology, the big hyperscalers, and all of a sudden all money's rotating back into low vol, and out of momentum, right? It's that the shift of funds, and you saw this huge spread of performance where low vol at that in the first quarter was up 5%, and the S&P was down 10%, off the top of my head, something like that. And it happened over the course of a month and a half. So to your point, it can happen quick.
And it'll happen on a Tuesday, apparently. That's my one takeaway from this call.
Yeah,
The
heard it
Tuesday
here.
after Memorial Day.
Jordan, you got anything you want to leave us with?
Yeah, I think just really quick, I would add on the valuation point. A lot of folks point to that the S&P PE, forward PE, is actually compressed year to date, which it has, right? If you look at it, but you got to look at what is driving that earnings growth under the hood. And it is energy stocks because of what's gone on with crude. Traditionally, those trade at a lower PE. And memory stocks. And talk about low PEs. I mean, Micron's PE got down to 5 times forward earnings. So you're seeing this earnings growth from
Why though? I think it's really important to call out why Micron trades at that valuation.
because of how
Because
cyclical
it's
that business
hyper-cyclical.
is. Yeah.
Hyper-cyclical, right? I mean, just 3 years ago, Micron recorded its largest net loss on record. This year, it's set to make $100 billion, which is more than Berkshire Hathaway or Meta, I believe. Right?
Yeah. So that's what gets pointed out a lot is, valuations have compressed, and they have, but the reasons why, and it might just be as easy as, hey, EPS up, stocks up, which is what you've seen year to date. But I would also add, whenever you talk about the tech bubble analog, people point to how valuations were much higher on the index level back then. And the one key difference is we have companies that are still private today that are about to IPO at $1 trillion, $2 trillion in valuation. The private markets back then were not nearly as liquid as they are today. So you have SpaceX, who just filed their S1. They're trying to IPO at a $2 trillion valuation. Easily would make them in the top 10 of the S&P. Oh, and wait, the indices are making it a lot easier for them to get in quicker. They don't have to be profitable. So think about what the index looks like whenever you put a $2 trillion company that has an operating loss. Or if you put two $1 trillion companies, Anthropic, OpenAI, that are burning cash, right? All of a sudden, look at Cerebras. I mean, I talked about it earlier. It IPO'd, it trades at 120 times sales. Now, if it's doubling sales every year, then maybe it grows into the valuation. And that's what a growth investor would tell you. But I would just say, yes, index level valuations today seem cheap compared to where they were back then. But look at what is coming in terms of supply of new issuance and the valuation that banks are trying to sell these things. That's all.
Tandem Talk is hosted by John Carew, Billy Little, Ben Carew, and Jordan Watson. Tandem Talk is produced by Elaine Natoli, Ariel Davis, Charlotte Woodham, and Mackenzie Farrell. This podcast is available on Tandem's website, www.tandemadvisors.com. Tandem Talk is also available for streaming and download on Apple Podcasts, SoundCloud, Amazon Music, and Spotify. Tandem Investment Advisors Incorporated is an SEC-registered investment advisor. This podcast is for informational purposes only and shall not constitute or be considered financial, tax, or investment advice, or an offer to sell, or a solicitation of an offer to buy any product, service, or security. Tandem Investment Advisors Incorporated does not represent that the securities, products, or services discussed in this writing are suitable for any particular investor. Indices are unmanaged and not available for direct investment. Please consult your financial advisor before making any investment decisions. Past performance is no guarantee of future results. All past portfolio purchases and sales are available upon request. Tandem makes no representation as to the accuracy of these numbers, nor should they be construed as any representation of past or future performance. Tandem makes no representation as to the accuracy of these numbers, nor should they be construed as any representation of past or future performance. This document was originally written/recorded in English. Tandem does not guarantee the accuracy, completeness, or reliability of any translated materials, and shall not be held responsible for any discrepancies, errors, or misinterpretations arising from the translation process.